Today is February 18, 2026, and something just snapped inside the financial system. Silver volatility just exploded to 115. For context, the normal range sits between 15 and 40. Anything above 100 is rare. The last time we saw this type of reading was when silver was trading near $120. But here's what makes this different. Volatility is now higher at $73 than it was at the all-time high. That means the options market is pricing more explosive movement now than it did at peak euphoria. That is not normal behavior. That is stress. Western spot silver is sitting around $73. Shanghai spot is near $86. That is a $13 premium between East and West. Physical metal is trading dramatically higher than paper pricing. In a balanced market, that gap doesn't exist. When physical demand holds firm while paper compresses, that's not a dead bull market. That's structural distortion. Now look at equities. The S&P dumped 1%, wiping out roughly $600 billion. Then pumped 1.1% within hours, adding over $650 billion back. The Nasdaq did the same thing. That kind of intraday whipsaw does not happen in healthy markets. That's forced deleveraging. That's hedge funds getting margin called and liquidating whatever sells fastest. And when gold, silver, and tech all drop together, the market isn't pricing fundamentals. It's raising cash. That is liquidity stress. Banks just tapped the Fed's repo facility for $11 billion. First time since early January during the last silver squeeze. Repo windows do not light up when markets are calm. They activate when funding pressure builds, when institutions need short-term liquidity. That's not retail panic. That's systemic tightening beneath the surface. Now zoom out to the macro alignment. The dollar is rising. The VIX is rising. Treasury yields are falling. That combination historically precedes major drawdowns. A rising dollar tightens global liquidity. A rising VIX means institutions are aggressively hedging. Falling yields mean bond markets are pricing economic slowdown. That is a defensive macro regime forming in real time. Charles Kindleberger documented this exact phase in financial crises. Euphoria, peak confidence, profit-taking, then panic as leverage unwinds. During the panic phase, fundamentals become temporarily irrelevant. Everything gets sold to raise dollars. That's exactly what we're watching. Technically, silver printed a swing failure pattern on February 6th. Price wicked below the December 31st low, but closed above it. That is inherently bullish structure because weak hands were flushed, but buyers defended the close. Current key support sits between 72.6 and 70. If we see body closes below that range, structure weakens, and lower levels like 67 become likely. If support holds and we get displacement with volume, 75 to 77 comes quickly. But volatility at 115 means turbulence, not certainty of direction. Institutional positioning adds another layer. A large buyer has been accumulating December gold call spreads at strikes that would require gold to more than double. Even after price weakness, that accumulation continued. That is not retail speculation. That is asymmetric positioning by serious capital. And we cannot ignore documented history. JP Morgan paid $920 million for precious metals spoofing. Traders went to prison. That's federal case law, not conspiracy. Paper pricing can override physical markets in compressed timeframes. But structural supply deficits don't disappear because of short-term liquidation. Silver is now in its fifth consecutive year of supply shortfall, roughly 200 million ounces annually. Global wealth allocation to silver sits near 0.03%, historically underweighted compared to prior bull cycles. Tomorrow, FOMC minutes drop. High-impact data follows. These are liquidity windows. Big players use them to reposition. Volatility expansion loves catalysts. Right now, what we have is compression. And compression does not resolve quietly. Let's be clear about what's actually happening. This is not silver weakness. This is liquidity removal. Large funds were long tech, long crypto, long metals, long everything, often with borrowed money. When tech cracked, margin calls triggered. To cover losses, they sold their most liquid assets. That includes gold and silver. Forced sellers don't ask whether fundamentals are intact. They sell what can be sold quickly. The dollar strength confirms it. When the dollar rises sharply, global debt tightens. Emerging markets strain, commodities weaken. It becomes a funding event. The bond market is quietly signaling slowdown with falling yields. Meanwhile, equities remain elevated because liquidity is still abundant, but cracks are forming. Hyman Minsky described how stability breeds instability. Long periods of calm encourage leverage. When stress appears, deleveraging accelerates suddenly. That's why prices detach from fundamentals temporarily. Silver dropping does not invalidate industrial demand. Solar expansion, AI infrastructure, electronics consumption, those structural drivers remain intact. 5 years of supply deficit do not vanish because hedge funds get squeezed. Sentiment has flipped quickly. Headlines are declaring the metals bull market over. That kind of fast emotional shift is often constructive for longer-term structure. Bull markets climb walls of worry. When fear spikes and weak hands exit, positioning resets. Now consider volatility itself. CVOL at 115 means the market expects violent movement within 30 days, not gradual drift, turbulence. The next month will not be calm. Either support holds and we see explosive upside after forced selling exhausts, or liquidity stress deepens and we test lower structural levels before recovery. There is no stable middle ground in this type of regime. Worst-case scenario must be acknowledged. If dollar strength accelerates, VIX continues rising, and tech undergoes another forced unwind, silver can break support and move lower short-term. Liquidity overrides thesis temporarily, but professionals understand this phase creates artificial dislocations. When forced sellers finish, price often snaps violently in the opposite direction. Look at the full picture. Volatility spike above prior highs. Repo facility activation. Dollar up, VIX up, yields down. Intraday equity whipsaws showing funding stress. Physical premium in Shanghai holding. Institutional call positioning active. Supply deficit intact. Sentiment washed out. That combination does not appear during ordinary corrections. It appears during regime transitions. The question is not whether volatility arrives. It already has. The question is whether you understand what deleveraging creates. Temporary distortion, followed by violent repricing once pressure releases. Invest with logic, not emotion. Understand liquidity before you interpret price. And watch the next 30 days carefully. This is not noise. This is structure shifting.